GDP, then a depression must be like 10 quarters of declining GDP because it's got to be worse. But that's not the definition. The definition of a depression, you can have growth in a depression, but it's below trend growth. In other words, if trend is 3.5, and you're actually banging out 1.5, 2, that gap between, let's say, 1.5 and 3.5% growth, that's depressed growth. It's an output gap. It compounds over time, and you never get it back. We are losing trillions of dollars of wealth. We are impoverishing future generations on a relative basis because of our inability to get back to trend growth. So the reason American people feel this and don't listen to the economists, and they're right, is because we're in a depression. So leaving that aside, the Fed at least understands the business cycle and the fact that the next recession, they say they don't die of old age, but they do die, and we're getting closer to the next one. So they are in a desperate race to get rates up to 3.5% before the next recession hits so they can cut them to get out of the recession. The question is, can you raise rates enough to cure the next recession without causing the recession you're preparing to cure? That's the dilemma. That's the finesse. My answer is no, they're not going to be able to do it, but they think they can. Why are they in this box? Well, because Bernanke should have raised rates in 2010, 2011, in the early stages of the expansion, when the economy would have been much better able to bear it than it is now. Bernanke skipped a whole cycle. He skipped a whole rate increase cycle to pursue these wacky experiments and, QE and zero interest rate policy and all that. I spoke to Bernanke about this, and he used the word experiment. He said this was an experiment. Bernanke made his academic reputation by studying the Great Depression, in the wake of Friedman and Anna Schwartz and some others. But he was a great scholar of the Great Depression, and he got his chance to kind of try out his theories. But what he told me was, he said 30 years from now, some new Ben Bernanke, some young scholar will look back and tell us if we did a good job or not. We actually don't know right now. See, the Great Depression was really two technical recessions, 29 to 33 and then 1937-38. But from 33 to 37, we had an expansion, but the whole thing was a depression because we never got out of it. The stock market recovered the 1929 high in 1954. It was a long time to get back to even. But Bernanke's mantra was, doing something is better than doing nothing. I completely disagree. It's better to do nothing if you don't know what you're doing. And this is really the monetary equivalent of the Hippocratic Oath. Doctors say, first rule of being a doctor is first do no harm. Anyway, bottom line is, by pursuing QE and zero interest rate policy, Bernanke failed to raise rates during the early stages of a cyclical expansion, which he should have done. If he had, the economy would have been just fine, and we'd be able to cut them today, but he didn't. So Janet Yellen now has to make up for lost time. So that's the mission. But again, and this is what the market completely does not get. And the Wall Street economists don't get. Nobody gets this because they see the Fed raising rates. And they've done the correlations and the regressions back to World War II. And they go, every time the Fed raises rates, the economy is getting stronger. So if the Fed's raising rates, the economy must be getting stronger. So bid up stock prices, et cetera. But that's like saying umbrellas cause rain. In other words, they've got the causality backwards. The Fed never leads the economy, ever. The Fed follows the economy. So a normal business cycle looks like this. So you get a little expansion going and unemployment starts to go down, and industrial capacity utilization starts to go up, and inflation starts to go up, and the Fed's watching, and then it keeps going. And they go, it's getting a little hot. We better raise rates. And they raise rates, but of course they started too late. The expansion keeps going, inflation keeps going up, unemployment keeps going down. Then the economy starts to cool down, unemployment goes up, and then prices go down, and capacity utilization drops, and we get into recession. Like, we better cut. And then they cut, and then you hit the bottom, and then you come out of it again. So think of that as like a nice, pretty sine wave, right? That's a business expansion, business contraction over and over, 30 or so times since the end of World War II, with the Fed always following the economy, never leading the economy. So all the big brains on Wall Street, they've got all this data, and they say, well, every time the Fed raises rates, the economy is getting stronger. That has absolutely been true for like 30 times since the end of World War II. It is not true today. The reason it's not true today is because Bernanke skipped the cycle and they're playing catch up. For the first time since 1937, the Fed is tightening into weakness. That's a key thing to bear in mind. The Fed is tightening into weakness. They are not leading the economy to strength. They are not responding to strength, even though Wall Street thinks they are. And there's a great danger that they're actually going to cause the recession they're preparing to cure, as I mentioned. The Fed will raise rates 25 basis points 4 times a year from now until the middle of 2019 until they get them to 3.25%. So like clockwork, every March, June, September, December for 2017, 2018 into 2019, look for a Fed rate hike until they get to 3.25%, at which point they'll be able to say, all right, now we're at 3.25. If we have a recession tomorrow, we can cut them back down to 0 again and get out of it. That'll be mission accomplished. Now, this is why I was sitting there in December like, yep, they're going to raise them in March. And right now, I'll tell your listeners they're going to raise them in June. There's your Fed response function. There's your baseline scenario. What are the exceptions to a Fed rate hike? Under what conditions will they not raise rates? Because everything I just described to you, they've had in mind since March 2015 when Yellen took patience out of the statement. That was the end of forward guidance. And by the way, if you go back to 2015, I said they're not going to raise rates all year, and they weren't going to do the liftoff that people were looking for in March, June, September, and they didn't lift off in September because the Chinese rate exchange devaluation, the stock market fell out of bed August 2015. Finally, they raised them in December 2015, and Wall Street was ready for March. I said, no, in June, no, September, no. It wasn't until December 2016 that they raised them the second time. So obviously, there are conditions under which they don't raise rates, notwithstanding the baseline scenario. So what are those conditions? There are 3. Well, 4 actually. So if you see job creation below 75,000, that will cause them to pause. By the way, pause is the key word. If you go home through the speeches, you'll see the word pause in Dudley's recent remarks. Pause is the Fed's jargon for we're not going to raise rates. We got the Jim scenario, which I took from the Fed. It's their scenario, or a technical recession. So, we're going to know Friday what the first quarter GDP is. It's pretty close to negative, but I'm not saying we're in a recession now. We might be. But if you see a recession, they'll pause. See job creation below 75,000, they'll pause. By the way, that's a very low bar. If you see a jobs report, see, this is the other thing that confuses Wall Street. You see a jobs report with 100,000 jobs. So Wall Street goes, oh, that report's really weak. The Fed's going to think twice. No, 75,000 is the number. Yellen told us that. It was in one of her speeches. You just have to be a geek like me and read all the speeches. So the third factor would be disinflation. So the Fed has this 2% inflation target. They've missed it for 6 years. They're finally getting close to hitting it. By the way, I think the listeners know they use the PCE core deflator year over year. There's PPI and CPI and core, a bunch of inflation indices, but we know what they use. PCE core deflator year over year. That actually has been getting close to 2%. But if you see it turn around, if you see that gap down to like 1.5, 1.4, 1.3, then they will pause. The last condition for the pause is a disorderly decline in stock markets more than 5%. If you see a 6, 7, 8% decline, so if the S&P went down 100 points, Fed doesn't care. Dow Jones goes down 1,000 points, Fed doesn't care. But beyond that, if you see the S&P start to go down 150 or the Dow start to go down 1,500 points in a disorderly way, it looks a little scary. It looks like there's no bottom. It looks like if you see that, they'll pause. So the Fed's going to raise like clockwork 4 times a year for the next 2.5 years, unless you see job creation below 75,000, disinflation, a technical recession. If you don't see one of those things, they're going to raise rates. And so right now, I don't see any of them. I mean, they could all happen, but it looks like, growth is going to be positive. Job creation has been decent, over 100,000. Disinflation is probably coming, but not quite here yet. And they'll want to see a couple months in a row. And the stock market's not crashing. So none of the pause conditions are in place. Therefore, they will raise rates. Simple. So the question is, will the Fed go down that path, do what they have to do the only thing they can do to subdue inflation at the cost of a very severe recession and something like a stock market crash? Or a couple of things. Number one, I would increase my allocation to cash. I'll stick with cash, but let me kind of put that in a context. The most powerful investment tool we have is diversification. Problem is people don't understand what diversification means. So I run into people all the time. They say, well, I'm completely diversified. I own 50 different stocks in 10 different sectors, semiconductors, consumer non-durables, minerals, et cetera. And I say, you're not diversified. You may own 50 stocks in 10 sectors, but you have one asset class, stocks, which are subject to conditional correlation. They, in calm markets, yeah, they're idiosyncratic, but in panics, they all go down together, or in bubbles, they all go up together. So you're not diversified. So what is diversification? Diversification is having slices of asset classes that are minimally correlated. It's not probably not zero, but as close to zero as you can get. So what would that be? You'd have a slice of gold, but I recommend 10%. People, I have some strong views on gold, and I've written a lot about it, but people are surprised to hear me say 10%. Like, oh, Jim, why isn't it 50% or 100% if you believe all this? Well, I do believe it. I wouldn't say it if I didn't, but you don't want to be 100% in anything. You don't want to be 50% in anything. 10% is fine. If I'm wrong, you won't get hurt. And if I'm right, you're going to make so much money that it'll actually kind of be the insurance on the rest of your portfolio. But that leaves 90%. So I would have a large slug in cash, maybe 30%. And people say, well, wait a second. Banks pay me 25 basis points. Stock market's going up. Why would I want to be in cash? That's horrible. A couple of things. Number one, the stock market might not always go up. Cash is the opposite of leverage. So leverage increases the volatility of the rest of the portfolio. You'll get much bigger returns, but you'll have much bigger losses. If you have a slice of cash and you've got a volatile asset over here, which are stocks, and other volatile asset over here, gold's fairly volatile. If you got that volatility and you have cash, it will reduce the overall volatility so you can sleep better at night. Cash is a great asset in deflation. And if you're talking about inflation, which is here, then you got to deal with that. But don't rule out deflation. If we go into a recession because the Fed over tightens, or, the thing about the inflation, just a quick aside, it comes in two flavors. There's cost push and demand pull. Demand pull is when individuals are worried about inflation and they start accelerating purchases, like, hey, I better go buy that washing machine right now because the price is going up, or better go buy that house right now because the price is going up. That's demand pull. Cost push comes from the supply side, not the demand side. And that's what we're seeing because of what we talked about, supply chain, energy cost. The Fed can't drill for oil. Raising interest rates doesn't get you more oil or natural gas. So the Fed can't do anything about it except kill the economy. Yeah, and that'll cool it off. But when you pay, I put gas in my car. I don't just read about this stuff. It used to be $45. Now it's about $75. Multiply that by 200 million cars across America. What happens is it reduces your discretionary income. If you're paying another $30 at the pump twice a week, then you're not going to go out to dinner Friday night. You're not going to, take a vacation, whatever it may be. So that depresses all those other areas. So there is this recursive function. So don't rule out deflation down the road. Not right away, but maybe next year. So cash. But here's the biggest value of cash. It gives you optionality. People don't understand this. What if I said to you, hey, I'll sell you a call option, an at the market call option on every asset class in the world? You go, gee, that sounds kind of valuable. Well, that's what cash is. When things are crashing, you're the one who can go shopping. And nobody's better at this than Warren Buffett. He's got his cash level at Berkshire Hathaway is at an all-time high. So there's a place for that. You can have some stocks, but I would look at the energy sector. I mean, I actually built and I own the largest non-commercial solar module field in New England. And I run my house off it. It produces about 7.5 kilowatt hours. So I know a little bit about it. And what I know is it doesn't work at night. It doesn't work in snow. It doesn't work in rain. It doesn't work in really cloudy days. By the way, you don't run your house off of solar modules. You run your house off of batteries.
Yeah.
And then the modules charge the battery. So you watch the battery level. That's how you manage it. So it works fine. But if you think you can run cities with that, forget it. So it's just not practical at that scale, even if you thought it was. And it isn't. That's very clear. But here comes wind turbines and solar. And I'm not against it. Like you say, I own one. But they're not scalable. They're intermittent. And they don't give you the base power, baseline power you need to run a modern power grid. Meanwhile, here's global demand. Okay. So the gap's getting bigger. It's not getting smaller. Renewables, whatever the pros and cons, are not closing the gap. The gap's getting bigger. There is no substitute for oil and natural gas and uranium. You got to put uranium in the mix. And hydro, if you live in Quebec, that's great. A lot of hydro, but not so much in the desert. And I've spoken to, without mentioning names, I would say you can go no higher in terms of who knows, let's just say board members of the 5 biggest oil companies in the world who said, yeah, as he said, we talk about that, but we can't say it publicly because we'll be, dragged, chained and dragged through the streets. But those are just the facts. So therefore, if you have an oil sector that's been bashed by the climate alarmists, but you can't do without it, which is true, buy some oil companies. When they're so there's your stock portfolio, private equity, venture, real estate, not commercial but residential, yes, and farmland. That's one of the hottest asset categories, and gold. So that's diversification, and that's the kind of portfolio you want, the kind of seasoned to taste. So the question is, will the Fed go down that path, do what they have to do the only thing they can do to subdue inflation at the cost of a very severe recession and something like a stock market crash? Or will they see that coming? They'll be the last to know. We'll all see it before they do, but they'll be the last to know. It's because they rely on flood models, and they're kind of in their own economic forecasting bubble, and they're very defective ways of thinking about the economy, and they're very much a creature of inertia. There are a whole lot of reasons why the Fed is not nimble. It's kind of quite the opposite. But they'll see it eventually, probably when it's too late. And will they balk at that point and stop rate hikes and maybe even reduce rates? That could save us from the recession, but that will just amplify the inflation. So rather than say which one's going to happen, I prefer to lay out those two paths and then just watch it very carefully. But more to the point, we've seen this movie before. This is a replay, and I think it's on, like you hit the remote control for double or triple speed. It's going to happen faster, but this is a replay of everything that happened from 2013 to 2019 and into 2020, which was, I'll just go through it quickly. So 2013, May, Bernanke says we're going to taper asset purchases. That's money printing, quantitative easing, whatever you want to call it. The market, tanks, bonds go down. Everyone's like, oh, it's over. Bernanke balked. But finally, in November 2013, they said, okay, the taper begins. They were still printing money, but at a slower rate, and that matters. That went on until late 2014. The taper was over. They stopped buying new assets. They said, okay, here come the interest rate hikes. Except they didn't come for another year. It wasn't until December 2015 that then Janet Yellen finally raised rates. And then another year for the second rate increase. So it was December 2016. So it was really, really slow. Took 2.5 years, but they got to 2 rate hikes. But then here comes Jay Powell. And then like clockwork, boom, 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 25 basis point hikes every meeting. And all the Fed was trying to do was to get back to normal. They were trying to get interest rates to maybe 2.25, 2.5, get the balance sheet down to, something like 2.5 trillion. They never specified it, but that would have been a reasonable level. So, okay, now interest rates are kind of normal, 2.5, balance sheets down around 2.5 trillion. We're back to normal. We finally got through the global financial crisis of 2008. We undid all that stuff. Well, what happened? From October 1st, 2018 to December 24th, 2018, the stock market dropped 20%. That was the December 24th, 2018, we call it the Christmas Eve massacre. Stock market went down 3% in one day. But the Fed was tightening into the weakness, as they always do. And the last interest rate hike, it was December 16th or 17th, within a day or two, but mid-December 2018, they were still hiking and raising rates. And that was the last straw. And then the market just tanked. And then finally, Jay Powell got the message first week of January 2019. He says, okay, that's it. We're going to be patient. Use the word patient. It's one of these code words. You have to get the code book out and see what it means. But patient means we won't raise rates again without giving you advance warning so you can get out of your carry trades or whatever. And then he went further, said, looks like we got to cut rates. And they did. And then by early 2020, here comes the pandemic. And then they took rates all the way back to zero. And then they started QE, I don't know, 6, 7, call it what you want. They took the balance sheet to $7.5 trillion after getting it down to $3.5 trillion. So look at that whole sequence from 2013 to early 2020, including the pandemic. What happened? They tapered the asset purchases. They raised rates. They sank the stock market. Then they said, okay, no more rate hikes. Then they cut rates. And then they started QE. And by April 2020, where were we? Zero rates, back down to zero, and the balance sheet was $7.5 trillion after getting down to about $3.5 trillion. So that was a big circle. They ended up back where they started from. But the point being, they failed to normalize. They failed to get rates where they wanted. They failed to get the balance sheet where they wanted. They did sink the stock market. Okay, now 2 years forward, here we are again. What are we doing?
They just raised rates at the March meeting. They're going to raise them again in May. I mean, that's the easiest forecast I've ever made. 50 basis points, May 4th. Boom. You can count on it. And they're going to announce. By the way, I don't have a crystal ball. The Fed told us this. I mean, that's the thing about the Fed. They may be wrong, but they're transparently wrong. So they tell you what mistakes they're going to make in advance. So that's the Fed forecasting is actually fairly straightforward because you just have to believe them. So they're going to raise rates again in May, probably 50 basis points. They're going to announce a reduction in the balance sheet. Whether they actually start it in May, they probably will. $100 billion a month reduction in asset purchases. So that's QT, quantitative tightening. In other words, they're running the same playbook they tried to run, or they started to run in 2013, 2014. They failed the last time. Why do they think they're going to be any more successful this time? Why do they think they can get out of this? And the answer is, the answer is they cannot without a recession. They can normalize rates in the balance sheet and they can stop inflation, but not without causing recession and not without causing a stock market crash. So the big question for the next year is, will the Fed do that? And they may. Or will they balk again, at which point you might rescue the market, but the inflation is just going to go wild. That's the debate. But the thing is about framing it that way. You've got two paths, and we'll get signals along the way. We won't be the last to know. The Fed will, but we won't. You'll be able to see this coming.
China doesn't have any of that. None of it. There's no significant Chinese bond market. They don't have the infrastructure of banks and dealers I described. They don't have the physical infrastructure. And most of all, they don't have a rule of law. You can't trust the Chinese as far as you can throw them. I was a facilitator and then a participant in the first ever financial war game ever conducted by the Pentagon. We did this at a top secret location called the Warfare Analysis Laboratory. One of the things we did there, I was on the China team. I wanted to make it realistic. So I said, let's lie, cheat, and steal, because that's what Wall Street does. And that's a more realistic game. So I recruited a friend of mine who's fluent in Russian to be on the Russian team. And I had dinner with him before we went down to the laboratory. And I said, look, here's the plan. I'm going to persuade my China team colleagues to basically announce a new gold standard. And we've accumulated enough gold, and we're going to say, for now on, our currency is backed by gold. We're going to put the gold in Switzerland to keep everybody happy. We're going to issue notes from a bank created in London under English laws to keep everybody happy. Here's the thing. We're going to say, from now on, if you want our exports, you have to pay for us in this new currency. We're not taking dollars anymore. And furthermore, if you want some of this new currency, you can deposit your gold in Switzerland and the bank will issue you some currency, so you're in the system. Or you can trade with us and run a surplus, and then we'll pay you in the currency and you can use that to buy our stuff. Or we'll give you loans. But one way or another, we're done with the dollar. And obviously this is very forward leaning, but the whole idea of a war game is to help the Pentagon think 5 or 10 years ahead. So the first thing that happened when you go to your embassy or conclave, you come out and you stand up at the podium, you announce your plans, and then everybody reacts and it's discussed, et cetera. The first thing that happened is there was a group. So we had the red team, the yellow team, the blue team, as the case may be, and they're all different countries or areas. But there's a white team, which are the referees. They decide what you did. And the first thing they did when we announced the gold move, they ruled it as an illegal move. They said, no, that's not in any of our scenarios. You can't do that. And I stood up, and about 100 people in the room, there were 3-star generals, CIA, FBI, I said, wait a minute. I said, this is a war. There are no illegal moves in a war. The whole idea is to be out of the box or live in a world where there are no boxes. That's what we're doing here. So they agreed. They said, okay, we think it's a really dumb idea, but we'll let you do it. Well, over the course of 2 days, it accelerated and gathered momentum. At the end of it, Russia got PowerPoints. Okay, so this was 2009. Within 10 years, so what facts happened? Within 10 years, Russia tripled its gold reserves. Last week, the dollar value of Russia's gold exceeded the dollar value of its treasury securities. They have 20% of their reserves in gold, and the value of their gold is more than the value of the U.S. treasury securities. They're dumping treasuries, buying gold. Exactly what we warned the Pentagon about 10 years ago. And here it is, and China has more than tripled its reserves. So we're not there yet, but we're moving to some kind of gold-backed world. But the point is, that was all in the war game. That's all in the book. And I made one other point. I said, currency wars don't happen all the time. They might only happen twice in a century. But when they happen,
they can last for 10 or 15 years. That's how long it takes to sort out. What you describe about the Chinese money supply is absolutely correct. People in the United States complain, oh, the Federal Reserve has printed $4 trillion in the past year. And they have printed $4 trillion in the last year. They're taking the Fed balance sheet from about 3.5 trillion to 7.5 trillion. So yeah, we printed $4 trillion in the past year. Didn't do any good, won't do any good, but we did it. But Chinese money supply is even larger and growing faster. Now, I don't want to get into the weeds on China's internal monetary policy. I could, except to say that they're grossly over-leveraged. The economy is investment-driven, not consumption-driven. They're about 45% investment. The U.S. is about 25% investment. So that gives you some idea of how investment is to the Chinese, which is actually okay if you're investing in productive assets that pay the way. They're not. They're wasting the money. I've been to China many times, been going back and forth there for 35 years. I've been out in the countryside. I don't just stick to the hotel lobby in Beijing. I got mud on my boots visiting these ghost cities. And so each ghost city, there are a bunch of them, actually seven. Imagine building 7 cities. That's what I saw. And so they got 1 or 2 skyscrapers, and they got mixed use, and they got retail shopping, a country club, a hotel, a golf course, a pond, highway stops, airport, etc. And it's all empty. I mean, it's just all empty. Shiny new construction, some of it still under construction, all empty. So I said to the communists, I said, what are you guys doing here? I mean, nobody's here. So, oh, don't worry. People will be coming from the countryside. They will be populating these cities. And I said, when? I said, no one's coming. And besides that, you've already drained the countryside. That already happened. But I said, you cannot mothball a building. It's not like some old clothes. I mean, the way a building maintains itself, it gets occupied and there's maintenance and people fix it and all that. I used to travel a lot in Central Africa in the early 80s. Zaire at the time, today it's the Congo. I was in Kinshasa, but it was right after the 70s commodities boom. And they took the money, of course they wasted it, and they built these skyscrapers in Kinshasa, which is like a swampy, scary, funky, city. But there's a skyscraper, but the windows are falling out and there were rust stains running down the side, and the elevators were broken. So it might have looked nice the day they built it, but it was never really used. And now it was literally, when I was there, it wasn't that much later after they built it, it was falling apart. So that's going to happen in China. My point being, if you apply, generally accepted accounting principles to their investment account, you would write it off the day they open the building because nobody's there. It's not worth anything. So they're wasting the money. They're over leveraged. They're overprinted. However, none of that has anything to do with the status of the Chinese yuan as a global reserve currency. The yuan is not a reserve currency. It will not be, probably in my lifetime, maybe never. And I'll tell you why. Because a lot of people don't understand what a reserve currency really is. You get a report from the IMF and it says, 60% of global reserves are in dollars, which is true, and about 25% are in euros, which is true. So 85% of global reserves are in dollars or euro, which means the only meaningful exchange rate in the world is the euro-US dollar cross rate. Everything else is working around the edges. You got some sterling and yen and Swiss francs and a couple other things. Aussie dollar is tiny, believe it or not, good currency, but not a big part of it. And China's like this kind of invisible 1% sliced down at the bottom. And China has $1.4 trillion in its reserves. But here's the point. It's not as if they have pallets of $100 bills stacked up in the basement of the People's Bank of China. They don't. You invest in securities. In other words, they're dollar-denominated securities. So it's not actually dollars. They're treasury bills, notes, and bonds denominated in dollars. So the thing that makes a reserve currency is not the currency, it's the bond market. You need something to invest in. So you need a liquid bond market with different maturities, different interest rates. You need dealers, you need auctions, you need payment and clearance systems, you need repo or repurchase agreements, futures, options, when issued trading, custodians, the rule of law. There's a whole massive infrastructure, which we started working on when Alexander Hamilton was, advising George Washington, and we've been doing it ever since. And others, Bank of England has done the same. China doesn't have any of that. None of it.
There's no significant Chinese bond market. They don't have the infrastructure of banks and dealers I described. They don't have the physical infrastructure. And most of all, they don't have a rule of law. You can't trust the Chinese as far as you can throw them. And so they have no chance of being a global reserve currency, none. Same with the Russian ruble, same with a lot of other currencies, same with Bitcoin. Show me the Bitcoin bond market. Maybe you can get my attention, but not sooner. So none of those are going to replace the dollar. First thing, my wife hates me to admit this, but I was once a registered lobbyist in Washington. I ran an office there. I spent a lot of time on Capitol Hill. And the first thing I learned in Washington is you can't beat something with nothing. In other words, if you hate a policy or a program, you just hate it, you write op-eds, fine. You're not going to change it unless you bring something to replace it. So for all the criticisms of the dollar, and there are plenty of them, you're not going to dethrone the dollar as the leading global reserve currency unless you can show me what you're going to replace it with. And there's one and only one contender in the world today, which is gold. So that's a whole other conversation. I'm not saying we're going to be on a gold standard tomorrow. As far as China's concerned, yeah, China's a house of cards. It's going to collapse. It's going to be ugly. Hard to say when, but probably sooner than later. And they know it. And they're not going to be a global reserve currency. So we can put China to one side, but yeah, China's a house of cards. Now, getting it back to the United States, the first point, let's talk about stimulus first. So yeah, the Fed printed $4 trillion. Congress, we had $1 trillion, what are called baseline budget deficits going into the pandemic. So with no pandemic, we were going to have $1 trillion deficit in 2020 and 2021. Now, Congress put $3 trillion on top of that with rescue and bailout programs last March, April, and May. That was the CARES program, payroll protection plan, aid to hospitals, extended unemployment benefits, higher unemployment benefits, et cetera. I'm not saying any of those things were bad. It was needed to keep things from getting a lot worse. But we put $3 trillion on top of this. So there's $4 trillion for fiscal 2020. They just did $1 trillion last week in the kind of final days of the Trump administration. So that's $5 trillion. And Biden has announced his plan. He's going to have a $2 trillion rescue bailout, so-called stimulus plan now. So that's $7 trillion plus the $1 trillion baseline for fiscal 2021. So there's $8 trillion in deficit spending in 2 fiscal years, $4 trillion of money printing by the Fed. Now, those are the numbers. That's not projections. That's baked in the pie. Just don't call it stimulus. It will have no stimulative effect. Does it, again, as I say, keep the lights on? Yes. Would some people keep their jobs last spring because their employer got payroll protection plans? Yes. Did other people benefit from increased unemployment benefits? Yes. Was a lot of that necessary because things were in such bad shape? Yes. So I'm not arguing that side of it, but it does not stimulate. It's not going to get us out of the depression. Let me be very specific as to why, because I don't make claims without backing it up. On the money supply, you can print all the money you want, but Milton Friedman was wrong. The monetarists are wrong. The Austrian school is wrong. Money printing does not cause inflation. What causes inflation is something called velocity, which is the turnover of money. The money has to be lent and spent. Banks have to be lenders. People and businesses have to be borrowers. You have to be spending it, get it in circulation, in other words, in order potentially to have some inflation. And that's the technical name for that is velocity. Velocity is dropping, sinking like a stone. By the way, it's been dropping since 1998. It dropped faster in the 2008 crisis. It's dropping faster today, but the trend has been very steeply down for the last 22 years. And so, nominal GDP, so the dollar value of all goods and services, leaving aside inflation, that's what we mean by nominal value. Nominal value of gross domestic product is money supply times velocity. How much money is there and how much does it turn over? Multiply one by the other, and that's your nominal GDP. And I remind people that $7 trillion times zero is zero. Meaning you can print the $7 trillion, but if you don't have any velocity, you don't have an economy. And so you can understand monetary policy is a desperate race between increasing money supply and declining velocity. One offsets the other so that you barely keep nominal GDP where it is. In fact, it's going to go down about 6 or 7%. We're not getting back to 2019 levels of output. If you take 2019 as your baseline, we're not getting back to 2019 levels till 2023.
at the earliest. We're not getting back to 2019 levels of job creation, the number of people who have jobs, until 2025 at the earliest. That's why I call it a depression, not a recession. Now flip over to fiscal policies. Like, hey, they're sending everybody $2,000 checks, and they are. The people are going to get those checks. And so the Wall Street, which usually gets things wrong. That's the first thing you got to know about Wall Street, because they don't really care about you. They care about rap fees and how they make money. So they're saying, all right, they're going to send out the $2,000 checks, and people are going to get those checks, and they're going to run right out, and they're going to buy a car, a refrigerator, paint the kitchen, whatever it may be. No, the first two things are true. They're going to spend the money, and they're going to borrow the money, and they're going to send people the checks. But when people get the checks, they're not spending it. What they're doing, they're saving it. They're either paying down debt, which is equivalent to savings, or they're putting the money in the bank, which is savings. So certainly if you lost your job, you're not going to take your friends out to dinner. You're going to throw the money in the bank or pay the rent. But even if you didn't lose your job, you look around, like maybe your spouse lost his job. Maybe your neighbor lost his job. Maybe you think you're next, like you have a job, but you're worried you're going to get fired next week. So you save it. And the name for that, economists call that precautionary savings, or, plain English, it's saving for a rainy day, except it's raining everywhere. So they are going to send the checks out, but people aren't going to spend it. And that's the reason you're not going to get the stimulative effect. But you are going to increase the deficit, which gets back to this debt to GDP ratio. So take the total debt divided by GDP. That's some ratio. The research is very convincing, very clear. A number of studies show this, that up to about 90%, so 90% debt to GDP, you get a little bit of something called a Keynesian multiplier, meaning you borrow $1, you spend $1, and you get $1.10 of GDP, or you get $1.05 of GDP. And it works maybe temporarily, but it works when people won't spend the money the government can. That's the idea. But when the debt to GDP ratio goes above 90%, that's what physicists call a critical threshold, or a phase transition. Now you're through the looking glass. Now the Keynesian multiplier drops below 1, meaning you borrow $1, you spend $1, but you only get 90 cents of GDP. But meanwhile, the debt went up $1. So what's happening to the debt to GDP ratio? This is going up dollar for dollar, but this is going up 90 cents on the dollar. So the ratio is getting worse. Guess what the US debt to GDP ratio is today? The answer is it's about 135%. So we're way past that 90% threshold. And by the way, who's in that club? I can tell you, Lebanon, Greece, and Italy. So there's your lunch table for four, the four super debtors league. And it just gets worse. And that ratio past 90% is a headwind to growth, because people look at it and like, hey, I don't have a PhD in economics, but I just don't like what I see. And people understand correctly, and this is the behavioral adaptation that policymakers on Wall Street do not understand. But the behavioral adaptations, people look at it and say, I don't know how this is going to end, but it's going to end. We're either going to have a default, or we're going to have something like hyperinflation to make the debt go away, or they're going to raise my taxes. Not sure which, maybe all of the above, but I have to save more money to meet my lifetime goals in the face of some bad outcome that's going to come out of this. That's the real world behavior, and economists know very little about the real world. So the point is, increasing the money supply doesn't work because velocity is declining. Increasing deficits doesn't work because people are saving, not spending, and they're preparing for worse outcomes. So neither one of these, you can call it money printing or spending, but don't call it stimulus, because it doesn't stimulate. We're not getting out of this. And that's why I call my book The New Great Depression. So 90% is the critical threshold. The US is at 131%, highest in history, which means we are well past the point where you can borrow your way to growth, or you can borrow your way out of a debt crisis. And we were heading for a debt crisis. So the way it works is raise interest rates, tighten money, reduce the balance sheet, et cetera, get unemployment up. It doesn't sound like a desirable goal, but that's what it takes. And that's what happened in 1982. Get unemployment high enough so people are buying hamburger instead of steak. They're buying, whatever is the least expensive thing on the shelf, day-old bread instead of new bread, or they're not buying gasoline because they're not going to work, et cetera. That will bring prices down, but at a very high cost, which we just talked about, which is high unemployment and lower productivity. Meanwhile, the U.S. debt keeps going up. We haven't really talked about the debt. That part of it looks like 1981. But if you throw in a global financial crisis, then it starts to look more like 2008.
Yeah, well, that's like a glacier. Glaciers are extremely powerful, but they move extremely slowly. There's some exceptions, but they kind of like, an inch a year, a couple inches a year. But they move mountains. I mean, they create rivers, they create canyons, they move mountains. They're extremely powerful but slow. That's a good metaphor for the impact of debt. And when I talk about debt, in particular with the United States, but you can apply this to any country, I focus on the debt to GDP ratio, because you can't really talk about debt in isolation without thinking about the capacity to pay the debt. And a simple example, if you have a $50,000 balance on your credit card and you're making $30,000 a year and trying to pay rent in New York, et cetera, good luck. You're probably going to go bankrupt or at least default on that card. But if you owe $50,000 on your credit card, but you're making $5 million a year, it's, you just write a check. It's no big deal. My point is, you can't look at a $50,000 debt and decide if it's a problem or not unless you compare it to the income. And if it's too low, it's a problem. And if the income's high, not a problem. So that's why you use the debt to GDP ratio. The US just hit $31 trillion in national debt. That is national debt, almost all of it in the form of US Treasury securities. Not all of it, there are other obligations, but mostly US Treasury securities. Well, is that a problem or not? Well, one way to answer the question is compare it to GDP, do the ratio. The answer is that ratio is now a little over 130%. What was it in 1980 when Ronald Reagan was elected? The answer is 30%. 30% is completely comfortable. That's like the person with the $50,000 debt is making millions. No big deal. 30% is comfortable. 50%, yeah, getting up there. Angela Merkel and all her years in Germany, and there's a lot of research to back this up, says that 60% was the limit. And that's what the Maastricht Treaty that created the European Union and the European Central Bank, that was their goal. They said, don't go over 60%. If you do, you're expected to take measures, raise taxes or reduce debt or reduce spending, do something to get that back down under 60%. If you say, what's the critical threshold where, water turns to steam, or, water turns to ice, or something changes in such a way that it's not the same. It's radically different, but it happens very quickly. The best research says the answer is 90%. And this comes out of, Ken Rogoff at Harvard, also Carmen Reinhart, who's now the chief economist at the World Bank. But they've looked at hundreds of cases over hundreds of years. And I like that because it's not just, kind of cherry picking data. Developed economies, developing economies, economies that issue debt in their own currencies, ones that issue debt in other currencies, principally US dollars, et cetera. So, a wide variety of case studies. And they show that when your debt to GDP ratio goes over 90%, your multiplier of additional debt goes below 1. So just to put that in context, at 30%, if I borrow $1 and spend $1, I might get $1.30 of growth. Assuming you spend it wisely. That's a big condition, but you borrow $1 and spend $1 and get $1.30 of growth. Okay, the debt was productive if you put it to good use. But that $1.30 gets smaller and smaller. As you get closer to 90%, it goes to $1.20, $1.10, $1.05. Past 90%, roughly, you borrow $1 and you spend $1 and you only get 95 cents of growth. You don't get your dollar back in terms of GDP. And then 90% and 85%, et cetera. So 90% is the critical threshold. The US is at 131%, highest in history, which means we are well past the point where you can borrow your way to growth, or you can borrow your way out of a debt crisis. And we were heading for a debt crisis. Now, Stephanie Kelton, she's the big brain of modern monetary theory. She's a professor at State University of New York. She says it doesn't matter. That they always point to Japan. Japan is at 280%, way past any member of the peer group. China's probably higher. China's a little more opaque because they are, but also they don't have as much national debt. If you look at the national debt to GDP, it's modest, but they have an enormous amount of provincial debt, and the
the banking system is owned by the government or controlled by the government. So when you throw in the bank debt, the state-owned enterprises, the provincial debt, and the government, so that's the real national debt. Stephanie Kelton says it doesn't matter. So human nature doesn't change, or at least it hasn't changed much in the last 100,000 years. So the fundamental laws of economics don't change either, but circumstances change, facts change, and that's important. Now, to answer your question, Kerry, you're right. There is a school of thought, a growing one, an influential one, that the debt doesn't matter. It's like, well, wait a second. So what? So the debt to GDP ratio went to 135%, which it did. Who cares? Well, what's wrong with it? 180%. We got issues. We got problems. Print up the money and monetize the debt and spend it and keep going. What is the problem? This comes under the banner of something called modern monetary theory, MMT. It's flawed. It's wrong, but it's got its followers, and those followers are now in the White House because one of the things Joe Biden had to do to get elected was to make peace with the Bernie Sanders wing of the Democratic Party. They take the view that if the Treasury didn't spend the money, how would anybody make any money? That's ridiculous, but that's what they say. They say, hey, when the Treasury spends money, what do? Well, they build aircraft. They have benefit programs. They have government contracts. They do whatever they do. But when the Treasury gives you the money, you take the money and you spend it on somebody else, goods and services, go out to dinner, have subcontractors, whatever it might be. That's the real source of money. They also take the Treasury and the Fed and they merge them. Now, that's not legally the case. The Treasury and the Fed are separate institutions. The Treasury is just part of the executive branch, and the Fed is an independent agency. And the Federal Reserve banks are actually privately owned. That a lot of people know. Some people know that, some people don't. But the Federal Reserve banks are privately owned by banks in the districts, so Citibank, Bank of America, et cetera. So they're completely separate. But the theorists ignore that and say, no, the Treasury needs to spend money because that's how the economy grows, and the Fed can monetize the debt. So you spend the money you don't have, you borrow to cover it, you issue bonds to cover the borrowing. And if the market wants to buy the bonds, fine. But if not, the Fed can buy them and put them away on the balance sheet, wait 30 years and collect the money. What's the problem? Who cares about the debt to GDP ratio? It's kind of a statistical abstract, but why should that stand in the way of using money to solve our problems, which are free healthcare, free childcare, free tuition, forgiveness of student loans? That's a $1.6 trillion ticket, by the way. And look, everyday readers and investors, there's no reason they should know all this stuff. This is total inside baseball. You have to be a geek like me to kind of keep up with it, but it's all coming. But what that means is we're going to test the Rogoff-Reinhardt thesis. Now, let me just take a minute to explain that. Up to a certain debt to GDP ratio, there is a Keynesian multiplier greater than 1. So the classic example is the UK was in a depression before the rest of the world. They have been hit pretty hard before the Wall Street crash. People aren't spending, they're saving. It's the liquidity trap. So if you get money, you pay down debt. When you don't have any debt, you put it in the bank. Whatever you do, you don't spend it. You hoard cash. Or people were buying gold. They were accused of hoarding gold, et cetera. But what they weren't doing was spending. And there was a lack of aggregate demand, and the banks were not lending. So Keynes said, well, if everyday people won't do it, the government must. The government can borrow. The government can spend. And what they discovered was that if you borrow $1 and spend $1, you can get $1.50 of GDP. Now, there's a separate debate as to whether that's actually incremental or whether you're just pulling growth forward. But so what? Even if you are pulling growth forward, maybe that's what you need to do when you're in a liquidity trap. But there's a problem. He called it the general theory of employment, interest, and money. But it was actually a special theory. I think he had a little Einstein on me because of the general theory of relativity, but it's actually a special theory, which means it's a theory that works in a set of circumstances, a set of conditions. The conditions where it works are you're either in a recession or just coming out of one. You have excess capacity and labor and industrial capacity, and you have very little debt.
In those circumstances, you can borrow a dollar, spend a dollar, and get more than a dollar GDP. The problem is that extra GDP you get for the borrow and spend, it goes down as the debt to GDP ratio goes up. What Reinhardt and Rogoff discovered is that at 90%, you go through the looking glass. Your payoff is now less than a dollar. You borrow a dollar, you spend a dollar, and you only get 90 cents of GDP or 95 cents, et cetera. So now, not only are you not getting your dollar's worth for the borrowed dollar or something more, which you did at lower levels, you're getting less than a dollar. So now what's happening? You're borrowing a dollar, you're spending a dollar, you're not getting a dollar of GDP, but you are getting a dollar of debt, which means your debt to GDP ratio is going up and the 90% is getting worse. And I just mentioned the United States is at 135%. So here are your two competing schools. There's the Keynesian multiplier and creating aggregate demand with government debt, and the Reinhardt Rogoff, more than a thesis, I would say powerful evidence that beyond 90%, it doesn't work. It goes under less than one on the one hand. And my friend Stephanie Kelton and Bernie Sanders and Kamala Harris and the modern monetary theorists who say, no, it's all good. How could you get growth if you didn't spend money through the government? These theories don't agree at all. We're going to find out which ones work. I'll give away the answer, which is that Reinhardt and Rogoff have it right. Keynes had it right up to a point. Reinhardt and Rogoff discovered that critical threshold, that whether you want to call it tipping point or phase transition, or which physicists call it or whatever. The modern monetary theorists think the opposite, and we're going to find out. But what it means, if Reinhardt and Rogoff are right, and I'm right, and Keynes was right, the more you borrow, it's actually a headwind to growth. Now you get just as up to the threshold, you got more and more and more. Oh, sorry, at a low level, you got more, but then it went down. But it's like any diminishing marginal return. You know, the curve starts very steeply, you get a lot of payoff, then it flattens out, then it goes down, but it's still positive. But at some point, it goes below the zero line and your marginal return is negative. And that's where we are. The debt's not going up at 2% or 3%. The debt's going up 8, 9, 10% or more. The U.S. had a $1 trillion baseline budget deficit, $1 trillion per year deficit for fiscal 2020 pre-pandemic. The Congress threw $3 trillion of emergency aid on top of that. And I'm not even criticizing all those programs. I mean, the payroll protection plan loans, the extended unemployment benefits, the increased unemployment benefits. Imagine where we'd be if we hadn't done that. But that aside, debt is debt. They piled $3 trillion on top. Now, this is going to take the U.S. debt to GDP ratio up to 135%. It was 106% when Donald Trump was sworn in. It's close to 130% today. Because remember, you got two things going on. It's a debt to GDP. So debt's your numerator and GDP is your denominator, right? Well, what happened? Well, the denominator shrank. This got smaller and this got bigger. So what happens to the ratio? It blows up. So now it's 135%. If you get the laws of economics right, which is not easy because most economists don't, but if you get them right, it's really a reflection of human nature. I mean, what is an economy other than all the people in the economy starting businesses, buying, selling, traveling, providing goods and services, et cetera. So human nature doesn't change, or at least it hasn't changed much in the last 100,000 years. So the fundamental laws of economics don't change either, but circumstances change, facts change, and that's important. Now, to answer your question, Kerry, you're right. There is a school of thought, a growing one, an influential one, that the debt doesn't matter. It's like, well, wait a second. So what? So the debt to GDP ratio went to 135%, which it did. Who cares? Well, what's wrong with it? 180%. We got issues. We got problems. Print up the money and monetize the debt and spend it and keep going. What is the problem? This comes under the banner of something called modern monetary theory, MMT. It's flawed. It's wrong, but it's got its followers, and those followers are now in the White House because one of the things Joe Biden had to do to get elected was to make peace with the Bernie Sanders wing of the Democratic Party. They take the view that if the Treasury didn't spend the money, how would anybody make any money? That's ridiculous, but that's what they say. They say, hey, when the Treasury spends money, what do? Well, they They build aircraft. They have benefit programs. They have government contracts. They do whatever they do. But when the Treasury gives you the money, you take the money and you spend it on somebody else, goods and services, go out to dinner, have subcontractors, whatever it might be. That's the real source of money. They also take the Treasury and the Fed and they merge them. Now, that's not legally the case. The Treasury and the Fed are separate institutions. The Treasury is just part of the executive branch, and the Fed is an independent agency. And the Federal Reserve banks are actually privately owned. That a lot of people know. Some people know that, some people don't. But the Federal Reserve banks are privately owned by banks in the districts, so Citibank, Bank of America, et cetera. So they're completely separate. But the theorists ignore that and say no. The Treasury needs to spend money because that's how the economy grows, and the Fed can monetize the debt. So you spend the money you don't have, you borrow to cover it, you issue bonds to cover the borrowing, and if the market wants to buy the bonds, fine. But if not, the Fed can buy them and put them away on the balance sheet, wait 30 years and collect the money. What's the problem? Who cares about the debt to GDP ratio? It's kind of a statistical abstract, but why should that stand in the way of using money to solve our problems, which are free healthcare, free childcare, free tuition, forgiveness of student loans? That's a 1.6 trillion dollar ticket, by the way. And look, everyday readers and investors, there's no reason they should know all this stuff. This is total inside baseball. You have to be a geek like me to kind of keep up with it, but it's all coming. But what that means is we're going to test the Rogoff-Reinhardt thesis. Now, let me just take a minute to explain that. Up to a certain debt to GDP ratio, there is a Keynesian multiplier greater than 1. So the classic example is the UK was in a depression before the rest of the world. They have been hit pretty hard before the Wall Street crash. People aren't spending, they're saving. It's the liquidity trap. So if you get money, you pay down debt. When you don't have any debt, you put it in the bank. Whatever you do, you don't spend it. You hoard cash. Or people were buying gold. They were accused of hoarding gold, et cetera. But what they weren't doing was spending. And there was a lack of aggregate demand, and the banks were not lending. So Keynes said, well, if everyday people won't do it, the government must. The government can borrow. The government can spend. And what they discovered was that if you borrow $1 and spend $1, you can get $1.50 of GDP. Now, there's a separate debate as to whether that's actually incremental or whether you're just pulling growth forward. But so what? Even if you are pulling growth forward, maybe that's what you need to do when you're in a liquidity trap. But there's a problem. He called it the general theory of employment, interest, and money. But it was actually a special theory. I think he had a little Einstein on me because of the general theory of relativity, but it's actually a special theory, which means it's a theory that works in a set of circumstances, a set of conditions. The conditions where it works are you're either in a recession or just coming out of one. You have excess capacity and labor and industrial capacity, and you have very little debt. In those circumstances, you can borrow $1, spend $1, and get more than $1 GDP. The problem is that extra GDP you get for the borrow and spend, it goes down as the debt to GDP ratio goes up. What Reinhardt and Rogoff discovered is that at 90%, you go through the looking glass. Your payoff is now less than $1. You borrow $1, you spend $1, and you only get 90 cents of GDP or 95 cents, et cetera. So now, not only are you not getting your dollar's worth for the borrowed dollar or something more, which you did at lower levels, you're getting less than $1. So now what's happening? You're borrowing $1, you're spending $1, you're not getting $1 of GDP, but you are getting $1 of debt, which means your debt to GDP ratio is going up and the 90% is getting worse. And I just mentioned the United States is at 135%. So here are your two competing schools. There's the Keynesian multiplier and creating aggregate demand with government debt, and the Reinhardt-Rogoff, more than a thesis, I would say powerful evidence that beyond 90%, it doesn't work. It goes under less than 1 on the one hand. And my friend Stephanie Kelton and Bernie Sanders and Kamala Harris and the modern monetary theorists who say, no, it's all good. How could you get growth if you didn't spend money through the government? These theories don't agree at all. We're going to find out which ones work. I'll give away the answer, which is that Reinhardt and Rogoff have it right. Keynes had it right up to a point. Reinhardt and Rogoff discovered that critical threshold, that whether you want to call it tipping point or phase transition, or which physicists call it or whatever. The modern monetary theorists think the opposite, and we're going to find out. But what it means, if Reinhardt and Rogoff are right, and I'm right, and Keynes was right, the more you borrow, it's actually a headwind to growth. Now you get just as up to the threshold, you got more and more and more. Oh, sorry, at a low level, you got more, but then it went down. But it's like any diminishing marginal return. You know, the curve starts very steeply, you get a lot of payoff, then it flattens out, then it goes down, but it's still positive. But at some point, it goes below the zero line and your marginal return is negative. And that's where we are. The U.S. is heading into recession, and we may be in a recession. Everyone's like, wait a second. Yesterday, GDP was up 5%. And it was. That was the number for it was the first government estimate for the third quarter of 2023. It was up 5%, but it was very heavy on consumption and very heavy on inventory. When wholesalers and distributors build up inventory, that counts as GDP. Well, it's fine to build up inventory if people are buying the stuff, but if they don't buy the stuff and you're up to the rafters in inventory, you got to start writing it down. This is where you see, you go to the Gap and you get like 10 shirts and 5 pairs of jeans for $30. I mean, the inventory situation comes down to the consumer. Are people buying stuff? It looks like the consumer hit the brakes in August. Now, the second quarter is July, August, September. Sometime around mid to late August, after 2 pretty strong months, and they were strong, the consumers just hit the brakes. Now, they've done enough to make the third quarter strong, but going into the fourth quarter, they may just, not show up for the game. A couple of reasons for that. Number one is during the pandemic, you go back to 2020, 2021, what was going on? Well, starting with Trump in, I think, June 2020, he gave everybody a $1,400 check. If you got a heartbeat, you got a check. And then Trump did it again in December 2020, just before he left office. It was another $600 check. Biden comes in and says, well, I can top that. And Biden does in February 2021, right after he was sworn in. Here comes another $1,600 check. And then when people got those checks, they saved a lot of it. So what happened in 2023? People drew down their savings. The savings rate got really low. Like, they spent the savings they had. They didn't make new savings. And then they turned to the credit cards and ran up their credit card balances. Well, that feels good for a while. But then if you're paying the minimum and rolling over the balance and you're at your limit, your credit limit's used up, and the interest rates are 20%, some of them are 28%, you're going to double that balance in 3 years. So if you're like, I'll just pay the minimum this month and I'll figure it out, your balance is going up because the interest is compounding faster than you're paying it down at 25%. So people are tapped out on their credit cards. They've used up their savings. They're getting into a deeper hole because the interest is compounding faster than they can pay off the credit cards. And they're just backing away. And it's showing up in things like gasoline consumption. It's way down. The demand for gasoline is what economists call inelastic, meaning you just have to buy it no matter what the price is. You got to take the kids to school or get to work or go shop, whatever it is. You're just going to buy the gasoline even if you don't like the price. By the way, lately prices have been coming down a little bit, which is another, that sounds good, but it's actually a bad sign because it's disinflationary, which kind of leans in the direction of a recession. But for gasoline consumption to drop, forgetting about the price, that means people are not driving. They're not going on vacation. They're not doing road trips. They're not driving any more than they have to. There are a lot of other signs. We don't have time to get into all the technicals with negative swap spreads and inverted yield curves and all the rest. But it does look like the consumer slammed on the brakes around late August, early September. The fourth quarter could be a disaster. The stock market's starting to wake up to that fact. So I would say it's a pretty simple recommendation, Matt. Reduce your exposure to stocks overall. Increase your exposure to cash. It'll give you, you won't lose money on cash, assuming that inflation is not bad. And it'll give you a lot of optionality. You can go, if things get really, really, really bad, if you have cash, you can go shopping and find some bargains. But if you're in stocks and they go bad, you're just going to lose that money and never see it again. But if you do have stocks or some stocks, I would look at energy defense, not for good reasons, there's enough wars going on, but defense will do well, and mining, because gold and silver prices and strategic minerals will do well. So defense, mining, and energy are the sectors I'd be in. I'd lighten up on tech, get out of everything else, go to cash. Treasury notes look attractive here because interest rates are going to start to come down. I know they've been going up, I get it, but it looks like they peaked and have turned around. So treasury notes, a good 2-year note, a 5-year note, will perform very well, and they're very safe, obviously. And just take it from there. But you've got to be tuned into the geopolitics to understand the stock market. You can treat them as separate subjects, but if the world's falling apart, so that's not good for stocks. Right. So when we say bond markets, Matt, we have to be careful which bond market. I'm talking about the U.S. Treasury bond market. The short-term treasuries, 4-month bills, 6-month bills, up to 1 year. The funny thing now is that the highest yields in the U.S. Treasury market are in like a 6-month bill. Like, wait a second, shouldn't I get more if I buy a 30-year bond, or shouldn't I get more if I buy a 10-year note? It's a longer maturity, more stuff can happen, inflation, bank freezes. All those things can happen. I want a higher interest rate for my longer term security. That's usually the way the yield curve looks. It's upward sloping. The longer the maturity, the higher the rate. That's not true today. The highest maturities are right around 6-month bills, 1-year bills, going out to 2-year notes. When you get to the 10-year note, you actually get a lower interest rate, lower what's called yield to maturity, than you do on a 2-year note. The interesting thing about 2 years is you get a high rate, but it's less volatile than a 10-year note. It's more liquid. 10-year notes are pretty liquid, but 2-year notes are very liquid. So you can actually have the best of both worlds. You can have a shorter maturity, which means less risk in some ways, and a higher interest rate. So it's like I said, the best of both worlds. But the highest interest rate is actually from 6 months to 1 year. So those are very, very safe securities, and they're paying like 5.25%, not quite 5.5%, but between 5.25% and 5.5% for a 6-month treasury bill. Why wouldn't you just buy one of those? I mean, it's more than what you get in the bank. Now, the answer is, well, yeah, Jim, that sounds good. But if interest rates go up even more, you're going to lose money on your capital. The value of the note or bond will go down if interest rates go up. That's bond math 101. Rates go up, prices go down. The opposite is true. Rates go down, prices go up. So you can make or lose money, but that inverse relationship kind of throws a lot of people, but that's just how it works. So yeah, buying a 2-year note that yields about 5.1%, very liquid, very safe, good return, more than your bank will pay you, more than most stocks will pay you. Why wouldn't you do that? Well, the answer is, if you think the 2-year note is going to go to 6%, you might not like it, because you're going to, if you hold it for 2 years, you'll get your money back. But if you want to sell in the meantime, you're going to have a capital loss on the note itself. So therefore, the next level of analysis is, well, what's going to happen to interest rates? Everybody wants to know that. In my view, they've peaked. They're going to come down. And if you like that action, you might prefer the 10-year note, because a longer maturity has a higher, not to get too technical, it's called DV01, dollar value 1 basis point. What it means is that, so interest rates come down a certain amount, 25 basis points, 50 basis points, or whatever. And I said bond prices go up, which they do. But how much do they go up? Well, the answer is, the longer the maturity, the more they go up. They're more volatile. And so the 2-year note's a really attractive piece of paper, very safe. You get your money back, liquid, you can get out of it, etc. The only reason not to buy would be if you thought rates are going to go up. I think they're coming down from here on out. But if you accept that view, then the 10-year note is going to have the biggest capital gains. Now, again, it's riskier. When I say risky, I'm talking about market risk. I'm not talking about credit risk. You are going to get your money back, but from a market risk point of view, if you had to sell it, a year from now or 6 months from now, for that matter, if rates go up, you're going to lose a little money on the value of the note itself. But if rates come down, not only do you get the 5% interest rate, which is sweet, but you're going to have a capital gain on the note, because that's what happens when rates come down. So the big question is, have rates peaked? And I would say they have. and I base that on what I said earlier about the economy. If we're going into a recession, we're going into a slowdown, we're looking at all kinds of geopolitical risks, stocks are coming down, then interest rates are going to come down too. People ask me, are we going to have a recession? And my answer is we might be in a recession right now and not even know it. We could be facing a global recession, including China, but just focusing on the U.S. Because that's the Fed's sort of territory. So Powell saying, the economy is great is nonsense. What he said, by the end of the year, we could be looking at 4.2% unemployment, 3.5 to 4% interest rates, and, kind of 2.7% inflation. And you're like, wait a second, inflation is 8.6 today. How do you get to, 2.7, number one? And then what about rising unemployment and higher interest rates? How do you reconcile those things? He said all three of those things. But what state of the world could make those things come true? There's only one, which is a recession. A recession would do it. A recession will raise unemployment. Higher interest rates will cause the recession, and the recession will cause inflation to go down. So in effect, Powell was saying we're going to have a recession. Inflation, prices go up, so we understand that, or maybe put differently, the value of your money goes down. You don't get as much for your money, same thing. But inflation, broadly speaking, has two causes. One is called, not to get too technical, but it's called cost push. This comes from the supply side. So there's a shortage of oil, and we've got a financial and economic war going on between Russia and the United States. U.S. really started, but U.S., EU, Canada, Australia, Japan versus Russia. That's obviously disrupting supply chain, cutting down energy supply, causing the price of oil to go up, et cetera. So that's coming from the supply side. And you're exactly right. The Fed can't drill for oil. The Fed can't plant wheat. The Fed can't make semiconductors. So they can't do anything about this. And the supply chains are breaking down. They were breaking down before the war in Ukraine, but Ukraine has made it worse. The other source of inflation is called demand pull. And this is when individuals, you, me, and all of our viewers and, everyday Canadians and Americans worry about inflation. We say, well, I'm thinking about buying a refrigerator. Better buy it now before the price goes up, or the car, or house, or whatever it might be. They're different, but they affect each other. When the cost push inflation from the supply side has enough effect, there's a tipping point or critical threshold in psychology. We say, maybe it is out of control. I better go buy some stuff. Then the velocity of money goes up, and then you get inflation. So the Fed can't do anything about cost push. They can't do anything about the price of oil, and you're right about that. But they're looking at the demand side, saying, hey, if this supply thing goes on long enough, eventually the psychology will change, and we'll get demand pull and behavioral, and that is really hard to change. So what they're trying to do, they know they can't change the supply side, but they're trying to squash the demand side before it gets out of control. Now, the question, of course, is can they do it? The answer is they can do it, but at what cost? So a general rule of thumb, this is really simple. You have to get, forget about nominal interest rates. Nominal interest rates are the rates you see on your screen, you hear about in the headlines and all that. Real interest rates are nominal interest rates minus inflation. Take the inflation out and see what's left. Well, right now, real interest rates are about 2%, actually 1.75% under the Fed policy rate. Inflation's 8.6%. So, just round numbers, 1.5 minus 8.5, that makes the inflation rate -7. That's nowhere near. It's got to be +2. Real rates have to be +2 to squash inflation. Right now, they're -7. So that implies that the Fed has to raise interest rates to 10.5% to get to +2 real interest rates. That's never going to happen. They're never going to get there. They will destroy the economy long before they get there. So the Fed has no hope of squashing inflation from the demand side, as you described, by raising rates, unless inflation comes down for other reasons. So what they're going to do, they're going to keep raising rates, 2, 2.5, 3, 3.5, 4, hope that inflation comes down from 8 to maybe 3, although I think that's a stretch. You could get into positive real rate territory, but they're really far away from it. So I think, by the way, I described what they're trying to do. I should make it clear they're going to fail. The only way inflation comes down, the way we're talking about, is if they trash the economy, a severe recession. If that happens, you say, well, do people still need to put gas in their cars? Well, you're right, but not if they're unemployed, because they're not going to work. there's a lot here that's just for show. It sounds good on TV, but there's a lot less here than meets the eye. But the point is, this is not over anytime soon. Even if it were, when you break supply chains, you can't just put them back together. It's like breaking a vase in 1,000 pieces, and you got to go buy a new vase. It's going to take years to undo this damage. So I spoke to the individual who was probably the single individual most responsible for building the modern supply chain. It was 30 years from 1989 to 2019. It was head of one of the largest companies in the world, and this is what they did, among other things. And he said, Jim, you have to understand, it took us 30 years to build it. It took us 3 years to blow it up. It's not going to come back in a year. This is going to take 5, 10, 15 years to build a new one. So it's what I call supply chain 2.0. Well, buying a refrigerator is a good idea. Buying a freezer might be a better idea. We're looking for food shortages by the fall. Now, when I say food shortages, in Africa and Middle East, this will mean mass starvation. You may see the greatest humanitarian crisis in history because they literally can't get the food. Everyone's like, well, gee, you can't get Ukrainian wheat. What's the big deal? Buy it from somewhere else. There is nowhere else. Canada and the United States grow an enormous amount of wheat, but we use most of it internally. And we feed, because it's not for humans, by the way, we feed our animals. This is how you feed cows, pigs. This is how you get beef and pork. This is an example of the supply chain, how it filters all the way through. So you would expect higher prices to persist. You would expect food shortages. Buying a freezer is not a bad idea. The future supply chain is going to be, it goes by different names. Janet Yellen calls it friendshoring. Macron calls it constellation. I call it a college of nations. But basically, we'll have supply chains and trade, but it'll be sort of members only. So US, Canada, Australia, Europe, others, Japan, will be invited to join, but not China. Russia is going to be in the waiting room for a while. We should be better allies with Russia, but the Democrats in the United States have pretty much made that impossible, at least for the short run. And then there'll be other countries that are kind of neutral in that scheme, Brazil, India, and others. But the point is, you'll still have trade and you'll have supply chains, but it'll be kind of friendly countries, members only, and exclude China. So that decoupling is going to go ahead. The Chinese seem to be not only fine with it, but they're actually leading the way. Semiconductor manufacturing is moving back to the United States. The 20 billion of new semiconductor plants from Intel. Why is Taiwan Semiconductor spending over $5 billion to build new semiconductor fabrication plants in the United States? Well, obviously because they're worried about China. We're reshuffling the deck, but none of this stuff is easy. Semiconductor plants take 5 years to build. A new refinery, forget it. That's like 7 to 10 years. We haven't had one in the United States since 1977. So it's going to take a while to do all this. Well, we can do it. So if I say we're definitely going to have inflation, you would know what to do. You'd buy gold, hard assets, land, silver, treasury notes, government bonds, etc. If I said we're definitely going to have deflation, you would also know what to do. You would reduce leverage. You would have more cash. And there are other assets you could go into. The problem is we could have both. There's no question we have inflation right now. It's front and center. But if the Fed squashes it and causes a recession or worse, you could flip to deflation very quickly. So this is going to sound like an obvious statement. What you want is diversification. Sounds obvious, but most people don't know what diversification is. I see people, I've got 50 stocks in 10 different sectors. I'm highly diversified. I'm like, no, you're not. You have one asset class called stocks. Real diversification, have a slice of stocks, gold, real estate, cash. Agriculture is a good investment. Energy, forget the Green New Scam. That's a joke. Oil and natural gas are going to be around for a long time.